All right, let's dive into a topic that honestly trips up so many people, using that 529 plan to pay for your kid's off-campus apartment. It's this tricky spot where tax law and real estate collide, and, getting it wrong can cost you big time. So, let's break down exactly what you need to know to get this right. So, I'm willing to bet you've heard some version of this advice, right? It sounds simple, it seems to make perfect sense, and frankly, it's what most people think is the golden rule when it comes to off-campus housing and your 529.
But that piece of common wisdom, it is completely 100% wrong. It's a myth, and following it could have you accidentally making a bad withdrawal, which means you're going to get hit with income tax on your earnings, plus a really nasty penalty. The real rules are definitely more complex, but trust me, understanding them is the key to unlocking the full power of your college savings.
Okay, so here's our game plan. First, we're going to bust that big housing myth. Then, we'll decode the all-important COA cap. After that, we'll navigate what I call the 12-month lease trap, talk about groceries and other tax benefits, and then I'm going to give you an audit-proof playbook before we run through some real-world examples. Ready? Let's jump in. So why is that dorm cost rule such a myth? Well, here's the thing. When your student lives off campus, the IRS doesn't actually care what the university charges for its own dorm rooms. Not at all. The real limit, the one that actually matters, is set by a totally different and very specific number. And this is the term you need to burn into your memory. Cost of attendance, or COA for short. This is the official budget that the university itself creates for financial aid. It's their own published estimate of what it costs a student to live and study there for a year. And that COA is the number the IRS uses as the hard and fast limit. Okay, so this slide breaks it down perfectly. The IRS has this two-pronged rule. If your student lives on campus, it's simple. The limit is whatever the university bills you. But, and this is the key for everyone else, if your student lives off campus, you can just ignore prong 1. It's completely irrelevant. You live and die by prong 2, the specific dollar amount for room and board that's published in that school's official cost of attendance. Now, here is the absolute crucial point. This cost of attendance number is not some national standard. Nope, it's set by each and every school, and believe me, the numbers can be wildly different. This means you just can't guess, and you can't go by what your friend's kid's school allows. And this just illustrates the point perfectly. Take a look at the University of Connecticut. They actually give you a higher allowance for living off campus, over $18,000. They get that it's more expensive. But then look at the University of Oregon. It's the complete opposite. Their off-campus allowance is almost $4,000 lower than what they charge for dorms. So moving off campus there actually shrinks your tax-free withdrawal limit. The takeaway couldn't be clear. You have to go find the specific official COA for your student's school and their living situation.
All right, let's talk about what is, without a doubt, the single most common and costly mistake I see families make. I call it the calendar mismatch. Landlords, of course, want a 12-month lease, but the school year? That's usually only 9 months. And that gap? Well, it creates a huge compliance trap.
This is the exact dilemma, isn't it? This is the reality for thousands of families. You are legally on the hook to pay for June and July, but your student is home for the summer. So can you use your 529 for those summer months? And the IRS rule here is brutally strict. Expenses have to be incurred while the student is enrolled, at least half time. That phrase, incurred during, that's everything. So the rent for June and July, when school's out, the IRS sees that as just a personal living expense, not a qualified education expense. And listen, this is true even if your total 12-month rent is way below the school's annual COA cap. The timing is a deal breaker.
And if you get this wrong, the earnings part of that summer rent withdrawal gets hit with regular income tax. Plus this, a 10% federal penalty, tacked right on top. That's a direct shot to the tax-free growth you worked so hard for. Ouch.
But there is a really powerful and elegant fix. If your student enrolls in summer classes, even just half-time, that creates a new official academic period. And just like that, the rent and food costs for those summer months become fully qualified expenses. It's an amazing strategy because you're turning a personal expense you had to pay anyway into a tax-smart investment that helps them get their degree faster.
Okay, so we've hammered on rent, but the allowance is for room and board. It's not just about the roof. That board part is for food, and it can add up to thousands of dollars a year. We're talking about reasonable grocery bills here, not going out to fancy restaurants. Documenting food costs is just as important as having that lease. Now, let's look at how all this interacts with other big tax breaks. So the IRS has this very strict no double-dipping rule. You just can't use the same exact dollar to claim two different tax breaks. But what's really interesting here is the difference in what's covered. The American Opportunity Tax Credit, the AOT, is fantastic for tuition and fees. But look, it specifically excludes room and board. And that little difference creates a perfect opening for some smart planning.
So, to get the absolute most out of your savings, you have to follow this stacking order. Step 1. Pay the first $4,000 of tuition out of pocket from a regular bank account. That lets you claim the full AOTC tax credit. Step 2. Deploy your tax-free 529 funds for all the room and board costs, since the AOTC can't touch them anyway. And finally, Step 3. Use any leftover 529 money for tuition costs that are above that initial $4,000. This makes sure every single dollar is working as hard as it possibly can for you.
You know, an IRS audit on this stuff usually isn't some scary in-person thing. It's a letter you get in the mail because the withdrawal number on your 1099-Q form is higher than the tuition number on the 1098-T form. When that happens, the burden of proof is 100% on you. So let's build your ironclad defense file before you even take out a dime.
This checklist right here, this is your key to sleeping well at night. 1. Go to the school's website and download the actual PDF of the official COA data. That's your legal limit. 2. Save a digital copy of the signed lease. 3. Keep a simple log of groceries and utilities. Your bank statements are probably enough proof. 4. Make sure you withdraw the money in the same calendar year you pay the bills. And number 5 is a pro tip. Have the money sent directly to the student's bank account. That way, if there's an error, the tax and penalty falls to them, and they're probably in a much lower tax bracket.
Okay, theory's great, but let's see how all these rules actually play out in the real world. We're going to walk through 2 really common scenarios that put all this to the test.
First up, the classic problem for any student in a place like New York or Boston or anywhere in California where the rental market is just completely disconnected from reality and from the university's standard budget. So, let's say your student's actual rent for the 9-month school year is $22,500, but the school's official COA cap is only $18,000. That $4,500 gap, that would be a non-qualified withdrawal. But here's the power move. You can file what's called a cost of attendance appeal with the financial aid office. You submit the signed lease as proof and basically say, hey, your official budget doesn't reflect the reality of this city. And a lot of times they will actually raise your student's personal COA cap, making that entire rent payment qualified. And now for our second scenario. This is a question I get constantly. Hey, I own a condo near campus. Can I just pay myself rent for my kid's 529? I get it. It sounds like a really clever loophole, but it's actually a pretty nasty tax trap.
Okay, here's exactly why this idea backfires. First, any rent you pay yourself is considered taxable rental income that you have to declare on your tax return. So right there, you've pretty much wiped out the tax-free benefit of the 529. But second, and this is even worse, the university is almost certainly going to reclassify your student as living with family. And that category comes with a much, much lower COA cap that barely covers gas and a few groceries, not rent. It's just not worth it.
So, we have covered a ton of ground here. From busting that old dorm cost myth to why the COA cap is king and how to handle that 12-month lease trap. The big takeaway is that being diligent really pays off. Yeah, the rules are complex, but they're not impossible. The real question you should be asking yourself is this: are you actively tracking and documenting all of these expenses from the rent right down to the groceries to make sure you get every single penny of tax-free savings you're entitled to? Thanks for watching.